All right, welcome to the Masterclass. Today, our focus is on one stock and one stock only, Broadcom. This is a semiconductor giant that, let's be honest, is at a major crossroads right now. For a professional trader, this isn't a time to guess. It's a time for a precise, disciplined plan of attack.
And that leads us to the big question, doesn't it? After getting knocked down from its highs, is this the moment to jump in and buy a fantastic company at a discount? Or is this just the start of something worse, a classic falling knife you'd be crazy to try and catch?
Here's the professional answer. There is no single right answer. It all comes down to who you are as an investor. What's right for one person is totally wrong for another. So instead of one move, we have a framework of 3 completely different disciplined strategies, each one built for a specific type of trader. Okay, let's break this down.
So here's our game plan. We'll start with a dilemma every trader is facing. Then we'll walk through the playbook for 3 different profiles: the conservative, the aggressive, and the swing trader. After that, and this is maybe the most important part, we'll cover the universal rules of execution that everyone has to follow. And then we'll wrap it up with the final verdict.
First up, Path 1, the conservative. Think of this as the foundation. It's a strategy built for people whose #1 goal is protecting their money and who are perfectly happy to play the long game.
So who is this person? Well, they're not trying to get rich overnight. Their main goal is capital preservation. They're thinking years down the road, not days or weeks. This is the playbook for pension funds, or really anyone who wants to sleep well at night. And their key tactic is simple: patience. They don't chase the stock. They figure out what a good price is, and they wait for the price to come to them.
And here are the exact levels they're watching. Notice something? Every single entry price is below where the stock is trading today. A conservative trader might set an alert for 335 and just wait. If it never gets there, they never buy. No harm, no foul. And for every single entry, you see a non-negotiable stop loss to protect the downside and crystal clear profit targets.
Now here's what's so powerful about this approach. The reward for extreme patience is just incredible. Let's say there's a big market pullback, and Broadcom actually drops all the way to 290. That's the Tier 3 entry. The risk-to-reward ratio becomes absolutely exceptional. You're risking about 7.5% for a shot at a gain of over 30%. That right there is how you create value through discipline.
Okay, let's move on to our second profile and see how it differs. Path 2, the aggressive. This is for the growth seeker, the person who's okay with taking on more risk for the chance at faster, bigger returns.
So the aggressive investor's primary goal is growth. Their time horizon is much shorter. We're talking 6 to 12 months. This is someone who's in their portfolio every day, actively managing it. And their tactic isn't to wait for a fire sale. It's to get in near the current price, but only after they see a clear technical sign that the stock has found its footing and is ready to bounce.
Now look at their playbook. The entry prices are right around where we are now. So the most important number on this chart for them is the stop loss. And they have a choice: a super tight stop, which gets them out fast if they're wrong, or a more moderate one that gives the stock a bit more room to breathe. The upside is solid, but the risk is managed with absolute precision.
And that brings us to our third and final profile. Path 3, the swing trader. This is the most tactical of all. It's designed for active traders who want to capitalize on price swings over just a few weeks.
Okay, the swing trader lives and breathes the charts. Their time horizon is the shortest of all, maybe 4 to 12 weeks. But their signature move, and you really got to pay attention to this, is that they never go all in at once. They'll start a position with, say, half their money, and they keep the other half ready to go just in case the stock dips a little further.
This table shows you exactly how that works. They put 50% of their capital to work at 343. If the stock pulls back to 324, boom, they deploy the rest. What does this do? It lowers their average cost basis to around 336. And notice how that changes the entire trade. They get a new combined stop loss and revised profit targets, all based on their better entry price. It's a really smart, flexible way to trade.
So we've laid out 3 very different playbooks. But talking about them in theory is one thing. Now let's put them all on the same chart and see how they stack up in the real world. This is where the whole thing really comes to life.
Okay, this chart puts it all together perfectly. See that vertical dashed line? That's the current price. You can see the entry points for the aggressive and swing traders are all clustered right there. But look way over to the left, that's our conservative investor, just waiting patiently. Now, look to the right for the profit targets and back to the left for the stop losses. That distance between them is the visual story of risk versus reward for each path.
In this chart, wow, this one illustrates the core idea beautifully. On the bottom, you have risk. On the side, you have reward. And the size of the bubble, that tells you how good the risk-to-reward ratio is. Bigger bubble, better trade. Now look at the two biggest, most attractive bubbles up in the top left. What are they? They're the conservative plays. They require the most patience, but they offer an absolutely massive potential reward for the risk you're taking.
No, listen, having a great strategy is only half the battle. The other half, and frankly the more important half, is execution. These are the universal rules. It doesn't matter which path you choose, your discipline is the only thing that separates a good strategy from a bad trade.
Think of this slide as your rule book. It takes the emotion completely out of the equation. A buy signal isn't a gut feeling. It's a price hitting a key level while the RSI, the relative strength index, is below 35. That's just a momentum indicator that suggests the stock might be oversold and due for a bounce. A sell signal isn't panic. It's the price hitting a pre-planned target. And the most important sell signal of all, when your stop loss gets hit. No questions, no hesitation, you just execute.
Protecting your profits is just as crucial. A gain on paper means nothing until you lock it in. So you follow a simple mechanical process. Once you hit your first profit target, you immediately move your stop loss up to your entry price. Right there, the trade is now risk-free. You literally can't lose money. Then, as the stock climbs, you keep moving that stop up to lock in more and more of that gain. This is how you stop a great trade from ever turning into a loser.
Okay, so with all the strategies and all the rules of execution laid out, what's the final verdict? What's the probability-weighted recommendation from this whole analysis?
First, we have to be honest about the current situation. This stock's valuation is high, I mean really high, compared to the overall market. We've also seen some insiders selling shares, and its Zacks rank got downgraded to a hold. These are real caution signs that tell us we absolutely need to be careful and disciplined.
And that leads to the single most important recommendation from this entire masterclass. Do not chase the stock. Here, the risk is just too high that you're buying right before it takes another leg down. The professional move is to wait. You set alerts at the key price levels we've talked about, and you let the market tell you when it's time to act.
And this table shows you exactly why patience is the name of the game. The most likely outcome, the base case, has a 60% chance of happening, and that gives you a solid 11 to 16% return. But there's also a 15% chance of a bear case, where the stock could drop another 10 to 15% from here. Waiting for confirmation is how you avoid getting caught in that bear trap.
So, there you have it, the complete professional playbook. You have the levels, the rules, the probabilities. The only question left isn't about Broadcom, it's about you. We've shown you the path of the conservative, the aggressive, and the swing trader. Now you have to decide, what kind of investor are you going to be?